stop number 12. Kaplan Corporation acquired Star on January 1st, 2014 by issuing 13,000 shares of common stock with a $10 par value and a $23 market value. So that's basically the consideration that was given. 13,000 shares at $23 a share. This transaction resulted in recognizing $62,000 of goodwill. Kaplan also agreed to compensate Star's former owners for any difference if Kaplan's stock is worth less than $23 on January 1st of 2015. On January 1st of 2015, Kaplan issues an additional 3,000 shares to Star's former owners to honor a contingent agreement. So basically, we're dealing with, in this particular situation here, where they bought it, but it was based on a contingency that the stock value would remain a certain level. And if it didn't, then they would provide more for the stock. The first thing it asks, the fair value of the number of shares issued. Which of the following is true? So basically, what they're wanting to know is Star's former owners honor the contingent consideration agreement, which is true. The fair value of the number of shares issued for the contingency, does it increase the goodwill account? The parent's additional paid-in capital from the contingent equity recorded at the acquisition date gets reclassified as regular common stock? Are all the subsidiary assets and liability accounts revalued for this extra money they gave? Or the additional shares are assumed to have been issued in 2014. So which of those actually is how it's being recorded? Basically, we didn't go over this particular problem last week. So basically, in the number 12, the way in which this is handled is when extra stock is issued at a later time, then that extra stock is going to be treated as the parent's additional paid-in capital from that equity gets recorded at the parent's additional paid-in capital from contingent equity recorded at the acquisition date gets reclassified as regular common stock in the next period. So we're not going to have a problem on that, but if we had a multiple choice related to how that contingency is stated in the parent's books, it's going to get reclassified. Instead of an additional paid-in capital, it'll be reclassified to common stock. Now, let's look at number 14. Crawford Corporation acquires Nashville Inc. The parent pays more for it than the fair value of the subsidiary's net assets. When we know that when more is paid, more consideration is given than the fair value assets, we generally have goodwill. On the acquisition date, Crawford has equipment with a book value of $430,000 and a fair value of $609,000. Nashville has equipment with a book value of $336,000 and a fair value of $441,000. Nashville's going to use a push-down accounting. After acquisition, what amounts in the equipment account appear on Nashville's separate balance sheet and consolidated income statement? So we know Crawford purchases Nashville. Crawford has a book value of $430,000. The parent, we don't adjust their book values of assets. We only adjust the subsidiary, what we're purchasing, their values, correct? Do you guys know what I'm talking about? So, when we're dealing with this number 14, basically, we've got a difference of Crawford's book value is $430. Ashford's fair value is $441. So the book value of $430 and the fair value of $441 are the amounts we're going to utilize for combining the books, correct? So, as you see here, the $100,000 excess fair value that got allocated to equipment is basically pushed to the subsidiary, and it increases that fair value to $441, which the fair value is. So the $430 plus that $441 is going to be the combined equipment value of the consolidated. We always use the book value for the parent and the fair value for the subsidiary. So $871 should be the amount that's shown on the financial statements. Remember, whenever we purchase a company in excess of the fair values, we're going to allocate, or in excess of the book values, we're going to allocate the fair values to the different assets. Any extra above that's going to go to goodwill. But when we consolidate the books, we're going to use the parent's book value and the subsidiary's fair value. Okay. Now, number 15 gets into exactly what I want you to know. So, this is pretty much what type of problem you might have on this quiz. Herbert acquired all of Rambus's company's outstanding stock on January of 2014 for $574,000 in cash. Annual excess amortization of $12,000 results from this transaction. Now we have this excess amortization because when we allocate fair value amounts to the various accounts, depending on their useful life, we'll amortize those portions. So let's say when we purchase a company, the equipment book value was $300, but the fair value is $400. And if the equipment has a useful life of 5 more years, we're going to allocate that extra excess fair value and amortize it over the next 5 years, whatever the life is. So they're telling us this excess amortization is $12,000. On the day of the takeover, Herbert reported retained earnings of $400,000, that's the parent. Rambus reported a $200,000 balance in their retained earnings. Herbert reported internal net income of $40,000 in 2014 and $50,000 in 2015 and declared $10,000 in dividends each year. That's what Herbert, the parent, did. Rambus, the subsidiary, reported net income of $20,000 in 14, $30,000 in 15, and declared $5,000 in dividends each year. So let's look at A. Assume that Herbert's internal net income figures above do not include any income from the subsidiary. If the parent uses the equity method, what is the amount reported as consolidated retained earnings on December 31st 2014. So basically what we're looking at is Herbert, in using this equity method, when they consolidate the retained earnings, what's it going to be? So if we look here, we see the parent balance at the beginning of the year is $400. Herbert's income, the parent, is $40. We always subtract the dividends. Rambus's income is $20. We also subtract that amortization we have to allocate. We also then show Herbert's income in 15, subtract Herbert's dividends, Rambus's income minus Rambus's dividends. Rambus's income, I'm sorry, we don't care about Rambus's dividends because we're not receiving any of them. We're trying to do a consolidated. And we also show the amortization each year. So they give us the information as of January 1st, 2014. They're asking us what will be the retained earnings in 2 years, December 31st, 2015. So in order to consolidate these, we have to go back and calculate it. We're going to start out with the parent's balance. We add the parent's income minus their dividends. We add Rambus's income. We don't mess with their dividends. We subtract the amortization in 14 and the amortization in 15 here. Then, let me just make sure I'm saying this right. In 2014, Rambus reported net income of 20 and 30 and then declared 10,000 in dividends. So I was wrong there, I'm sorry. So what we're doing here is by combining them, we're starting with the parent's initial retained earnings. We're adding the parent's income, subtracting their dividends and the amortization. Then we're going to separately add Rambus's income for both years, and then we're subtracting only the dividends that Herbert paid out. Okay? So what happens here is 2 years later, the combined or consolidated retained earnings is going to be $496. So basically, we're starting with the beginning balance. We're adding any parent's income minus dividends, minus any amortization each year we have to take on that subsidiary. And then we're adding the subsidiary's income. Now the next part says, would the amount of consolidated retained earnings change if the parent had applied either the initial value or partial equity method for internal accounting purposes? No. Know that these three methods that are used are just for internal purposes. Ultimately, the ending retained earnings, no matter which method they use, is going to be the same. The issue with the internal methods that are used is in order to create then the consolidated financial statements, they'll have to make adjustments based on which method they use. So they're going to be the same regardless of which method is used. Now, B basically asks now, under each of the following situations, what is the investment in the Rambus account balance on Herbert's books if the parent uses the equity method? Now remember, the equity method is going to take into account everything. They're going to take into account the income minus the dividends minus any allocations. So